Hey, Money Vikings, welcome back. Thank you for joining me. A very interesting one that I want to talk about today and share with you some ideas about portfolio construction through the decades as we age. And I'm going to go into my personal thoughts and theories on all this. And obviously, I'm also going to lay out what the professionals say. And I just think that this is going to help give you a better sense of how to develop and organize your portfolio through the decades. So, obviously, in a lot of ways, a portfolio that someone puts together in their 20s when they're just starting out might be a lot different than someone that's in their 60s, 70s, or 80s. And I want to talk about the theories behind that, but I'm also going to throw out some counter arguments to all that and give you a little bit of my personal perspective, the way things go. So, in general, portfolio construction is the most critical thing, I think, in terms of your long-term wealth building. And that is way beyond picking any individual stock or anything like that. You know, the number one thing is automating, but the second, I think, most important thing is what you're automating into, okay? So obviously over the last, 80 plus years, an index fund that captures the 500, largest companies in the United States has done very well. There's really no sign of that not continuing. It probably will continue. But over time, as we see through those last 80 to 100 years, there are times when, large U.S. company stocks and the overall market in general, basically go down a lot. So, there can be years where it'll go down 30, 40%. The good news for people that can just ride that out and go long term is that it's always come back. So, yeah, there could be a down year and stocks will plummet 30%. But what ends up happening is a lot of times if you look at charts and you look at the returns throughout history, the next year it'll come right back. And typically you have a couple of up years and then maybe another down year or a flat year, and then some more up years, and then a down year. But basically, if you zoom out, right, over the long span of time, the market is going up. Now, if you zoom in, it's got, these drops and then back up and then drop and then back up and then drop and then back up. Okay. But it's basically going like that, which is up. Okay. Over time. So what ends up happening though is that we don't want our nest egg to run out of money. So that's why, generally speaking, the rule of thumb is that as you get older, you get more quote unquote conservative with your portfolio. So in your 20s, I found this chart here, and this is starting with someone in their 60s. There's an argument to be made that someone in their 20s and 30s, maybe even early 40s, should be just highly invested in S&P 500 growth stocks, right? That are more risky, but they're going to get better returns over time and better growth. But the big thing about that is it has to do with your risk tolerance, right? So a lot of people really have to look in the mirror and think about if they can stomach a 30, 35% drop. But here's an example of in their 60s, a person is 50% in stocks, and this is like an index fund, not individual stocks. That's even more risky. They are 40% here in bonds, fixed income. Bonds are considered safer because bonds pay a specific yield or interest rate on your money, and then at the end of a maturity period, you get your principal back. So if you buy a $50,000 bond in a municipal government water project, it might pay you 5-6% a year. And then at the end of something like, it just depends, they all have different maturity dates, but at the end of 20 years, you'll get your original 50,000 back. And all along the way, your 50,000 was making money and paying you. Okay. So there's that. That's kind of giving you income off the money. And then this person has 10% cash. All right. So that's a moderate, portfolio. This actually is somewhat close to what I do, even though I'm not 60. I'm in my mid to late 40's, but it has to do with my risk tolerance for the bulk of money, right? So I don't want to see the bulk of money go down like crazy. I don't want to see it when it drops 35%. I just want my portfolio to go down 20% or 19% and have some of it kind of like more secure. It's like I don't have that like gut wrenching feeling. So that's just my own risk tolerance. I will dabble in riskier assets, but I do it with very small amounts of money. I consider it play money and just fun money. Okay. So then another rule of thumb that I want to throw out there that is really popular actually is you take your age and okay, so at the age, so what you do is you take your age and you take 100, or what is it? Okay, Americans living longer. You take 100 minus your age. So let's say you're 30 years old. So if it's 100 minus 30, that's 70. You should have 70% of your portfolio in stocks, right? So as you can see, what happens is as you get older, so when you're 60, 100 minus 60, you're only going to have 40% in stocks. So as you get older, you're having less and less in stocks. Okay. So that's a pretty good rule of thumb as well. So a person that's 50 would have 50% of their investments in stock index funds, and they'd have 50% in bonds and maybe a little cash, right? 10% cash, something like that. And then as you can see, that gets less and less risky over time. So you go more towards bonds as you get older. With people living longer, as this mentions, some people are using 120. So that's actually to stay longer in stock index funds. So like longer in stocks. Okay. Now let me give you a caveat to this rule. And it goes to my principle of this. You know, I think that sometimes people believe they get very fixated on the big number of their portfolio and how it's going up and down every month or every year. And that's really not the point. Because again, you're trying to build a nest egg that will pay you monthly when you retire. Okay, it's paying you, it's a passive income machine. So the month to month up and down honestly doesn't matter. You want it to be trending up, okay? But you can have some down months and even a down year, but then you want it to keep, going back up. But the big thing is this, if you can take some volatility, it wouldn't hurt, I think, to be in stocks longer. A good example of this is Warren Buffett. I mean, he's, Charlie Munger. I mean, they're in stocks, and those guys are in their 90s, right? They're in a diversified portfolio of stocks. And as we, get older, there's another factor here. We might want our nest egg to continue to grow and stay strong. And we also might want to pass on some of that money as an inheritance to our heirs. So if that's the case, that nest egg is actually going to continue to grow over time because it's outlasting your own personal life. The idea behind this rule is that you would never run out of money, right? Because you're getting more and more conservative over time. But you do have to balance that with fighting inflation, okay? So back to the other charts, I'm going to go out here and show you, here's some like really conservative. So it says like age 70 to 79 and then age 80 plus. What you have here is, you have an 80 plus person that's 55% in cash and 35% in bonds and only 10% in stocks. So that's a real conservative portfolio right there. That portfolio I would actually worry about with inflation and not quite keeping up. Maybe barely keeping up, but not much because you've got 55% of that portfolio that's really not making much. I don't know, in a savings account, can you get 2 or 3% in a high yield savings account? Maybe, I don't know. Inflation usually runs at least 3. It's been running hot lately. I think it's gotten down to a 3 now. So you have to beat that. So anyway, what's your allocation all about, and what's your theory behind it? Please share. I'd like to know. Please put it in the comments. I'd like to know what you think is the best allocation. There's no perfect here. I think this is a combination of sound financial advice and your own specific feelings about investing and volatility. And if you can take a little volatility over the years, you can stick to your guns through the down times when it does drop 35%. I think a person's going to be fine if that happens over the long run. But they may not want 100% of their portfolio in stocks, because if they have a $500,000 portfolio that's all in stocks and the market drops, let's say 35, 40%, yeah, they could be looking at a portfolio worth $300,000 and it was at 5. That can be a tough pill to swallow. It really can. So that person, if they have that size, they may want something that's just a preservation of capital. Maybe they have 300,000 in bonds and in cash, and they got 200,000 in the stock market, right? So that if that market crashes or goes down a bit, that 200,000 is just losing, 50,000 or something like that. So anyway, please share your thoughts. Love to hear them, and see you guys on the next one. Thanks.